Jay Kaeppel is Senior Research Analyst in Sentimentrader.com. Jay, thank you so much for having us a few minutes.
Thank you for having me back.
Jay, after the worst first half of the year for the market in almost 50 years, 52 to be exact, are investors too bearish about U.S. stock market?
Well, actually, we're seeing a lot of mixed signals right now. It's kind of a different equation for traders versus long-term investors. For traders, on a short-term basis, we're seeing a lot of oversold indicators and a number of sentiment indicators showing too much bearishness actually in the U.S. market that are giving bullish signals. So on a short-term basis, I'm hoping for a tradable rally right here. In the U.S., historically, the quote-unquote summer rally is basically the last few days of June through about the middle of July. That 12-day period over time has outperformed the rest of June, July, and August combined. So I'm hoping for a rally here in the short term before perhaps we go back into the doldrums, because the bad news, more for longer term investors, something that we created called the macro index model, which tracks a number of economic indicators, has taken a ugly turn for the worse in the last 2 months. And essentially, to boil it down, right now it's suggesting about a 60% probability of a recession in the next 12 months. So, we'll see what we get. But the real question is, has the market discounted that already? I have a chart, if they can bring it up here, chart number 1, and what it shows is 4 major indexes in the U.S., the Dow, the S&P 500, small cap index, and the NASDAQ 100. And the thing to note about all of them is this is classic bear market setup. They're all below their long-term 200-day moving average. The 200-day moving average has rolled over. So one of two things is going to happen. Either it's going to bounce and forget all about this, or this is how long-term ugly bear markets play out, with these indexes moving down, with those averages moving down. So for longer term investors with cash, my opinion is you don't want to be a hero right here. You want to kind of wait till you get some confirmation that things have turned around.
We are seeing, meanwhile, this chart as you mentioned. Jay, commodities are slumping from historic heights. Could this mean inflation is on the way down?
Right. Well, that's the theory. All of a sudden, everybody went from being afraid of inflation to, well, commodities are going down, so obviously we're going to go into deflation. I think we have to wait to see how that plays out. I actually want to jump in to the bond market as kind of a preface to the commodity market. The second chart that I had, number 2, what it shows is the yield on the 30-year U.S. Treasury bond, and it goes back to 1972. You see where 1980 interest rates went up to about 15%, and then we had a 40-year decline in interest rates into March of 2020. And then it's been up since then. Now the red line is a 10-year moving average, and the way I use this is very simple. If the numbers are above that red line, that tells me we are in a rising interest rate environment. And what that also tells me is I want to be very careful in the bond market, especially long-term treasuries. So the key number right now is about 2.75% on the U.S. 30-year Treasury. If it's above there, that means rates are in an uptrend, and you want to be careful in the bond market. And if they drop back down below that, and that's basically what you were touching on, is people are saying, well, rates are going to, commodities are starting to back off, inflation is going to back off, and yields will come down. This ticker, which is ticker TYX, is a really handy thing to watch to keep an eye on what the real trend of interest rates is. And then to go back to your original question about commodities, the third chart that I have, this is just one ETF. It's ticker DBC, and it tracks a basket of commodities. There are different ETFs that trade different baskets, but they all look kind of the same. And basically this one goes back about 13 years. But if you look at the far right, you see in the last 2 years, obviously we had a huge run up in commodities. And that is kind of what perpetuated inflation. And then in the last 2 months, you can see it on this chart, you know, a big sell-off, about 20%. And like I said, the conventional wisdom has all of a sudden shifted almost overnight to saying, well, that's it. Commodities are done. Commodities are over. I'm not so sure. And the reason I say that is the fourth and last chart that I had. This is a wild-looking thing that goes back to the 1930s. This black line is a commodity price index divided by a stock price index. So when this black line is rising, it means that commodities are outperforming stocks and vice versa. And you see a lot of big swings across history. But if you look to the far right, that little red circle, what we're seeing is commodities got beaten down relative to stocks to almost a historically low level, and then finally turned it around in the last 2 years. If you take a close look at this chart, you see the history. There is a chance that this line just keeps going over the next 1 to 3 to 5 years, maybe even longer. And my opinion at the moment is that commodities will outperform stocks over the next 3 to 5 years. But this is the line that I will keep an eye on to tell me if that's true or if that's turned around and is not true anymore.
And Jay, what about the relation between markets and U.S. jobs report? Today we've known U.S. economy added 372,000 jobs in June, defeat expectations, and the jobless rate held steady at 3.6%. But we are seeing lagging participation rate, and it took a step back to 62.2% from May's. Which interpretation are markets doing?
Yeah, well, you know, personally, I'm not so much interested in the trend of jobs. What I'm interested in is how the stock market reacts to that. So today is going to be an interesting day because the number came out and I think it disappointed originally, and the markets were down. The stock market here was down fairly hard. Last I looked, they were up. So I'll be curious to see how they end the day, because when the stock market starts shaking off bad news or indifferent news and starts rallying, that's usually a good sign. You know, I don't know where joblessness is going to go. My guess is it's going to rise due to inflation. But again, the key thing to keep an eye on is how does the market react to bad news and to good news? Because if it does the opposite of what most people think it's going to do, that's telling us something.
And Christopher Waller and James Bullard, both Fed members, stressed the need to get policy into restrictive territory to confront the hardest price pressures in 40 years. Fed swaps showed increased odds of 75 basic points hike after June jobs data. What do you think about these probabilities for next monetary policy meeting in July?
Well, if you're asking about interest rates, I don't know. I don't have anything that allows me to predict what interest rates will do. With a lot of these markets, and in fact, with the charts that I showed you, I'm a trend follower by nature. And that does pretty well in the financial markets rather than trying to pick tops and bottoms. So that long-term chart of Treasury yields, as long as that's in a rising configuration, as long as 30-year Treasury is above the 10-year average, I think interest rates continue to head higher. The thing to remember, even if inflation does come down, right now we're in a 3% interest rate, but 8% inflation rate world. So there's not a lot of value in bonds right now. And so you're going to need much higher interest rates or sharply lower inflation to make those worth piling into.
Jay, as you mentioned, yield curve, we've seen this week how Jay, I'm saying yield curve inverted again this week. We have seen how bonds flash recession warning light as a key part of this inversion again. What it is telling us? It's telling us we are in a recession now in the US.
Well, I have mixed indicators. As I mentioned before, the macro index model that we follow is now in bearish economic territory. It's saying there is a risk, a serious risk of recession. Whether or not we're in one right now, I have not seen the evidence in terms of the numbers. I have another model that I follow that uses fewer indicators, and that one looks just fine, but that doesn't factor in things like housing, and I think that's kind of weighing on the economy right now. The home prices have gone up so much, and now rates have gone up, so affordability is a problem. So I think there is a danger now of a recession, more than I thought a month ago, but I just keep an eye on the indicators. And again, the real question is, how does the market react to that news? The market tends to look 9 months ahead. So if it's already factored in a recession, then things might not get that much worse for the market. But the thing I would suggest is keep an eye on the recent lows for the S&P 500 and the NASDAQ. As long as those hold, again, on a trading basis, I think there's great opportunity here. But if they start to break down through those lows of last month, then it's all bets are off.
Thank you so much for this analysis. Jay Kaeppel, Senior Research Analyst at sentimentrader.com. Thank you, it's a pleasure.
Thank you for having me on.